Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are still working on the assigned homework problems for Chapter 4, the problems from Group B. And as always, accounting is about understanding theory, concepts, and applying that theory and concepts. So if you're watching the video and you're not getting it, after watching the video, you should get it if you didn't understand the application part. But if you're still not understanding it, then it has an issue. It has to do something with the theory. Understanding the concepts. So my recommendation is to go back to the theory videos and rewatch those. Remember, you can always pause the video and watch them again. If you're still not understanding the theory, then feel free to contact an instructor by email or telephone, and we'll help you understand that. And like I said, it's just a matter of if you're not getting the application side, then just watching the video, you should pick up the application part, but most people struggle with the theory. All right, so the video is going to be for 4-47, and it says here, let me get my pen. All right, it says here the adjusted trial balance. So this is an adjusted trial balance, and that means that, if I were creating this trial balance, I would have written the word adjusted right here, okay, so that we would know it's an adjusted trial balance. But the adjusted trial balance means that those are the figures that we're going to use to create our financial statements. So this is as of November 30th, and this is the trial balance. Now notice down here, you have selling expenses, general expenses, okay? So this here is a total of the selling expenses, and this is the total of the general expenses. So it's going to ask us to prepare a multi-step statement for November for fresh foods. So if you go back to exercise, right, 4-33B, okay, I believe in there I have an explanation as to the 43B. I believe they had done the income statement. I think it was 34B. We did the balance sheet, and I had explained in those videos my thought process or my thinking about how they're presenting the information and the solutions, and using multi-step versus single step. And I actually would try to show, I'm showing you my thought process when I'm creating the financial statements, and of course what I create is would look different from the solution. So if you go back to those exercises, okay, and watch those exercises in order to get a better understanding of how I'm creating the financial statement versus what you see as a solution in the textbook, okay, in the solution manual. Now for this one here, it says we're going to create a multi-step income statement, and we're going to calculate the gross profit percentage. And then what does the gross profit percentage mean? Now, in creating the multi-step income statement, and I looked at the solution, the reason why I pointed out the selling expense and the general expense is because we're only getting that as a total of the selling expense accounts and a total of the general expense accounts. In the exercise 4-33B and 4-34B, you'd hear me say that those two accounts are not general ledger accounts. They'd never be used as general ledger accounts. So what they're doing is they're lumping everything together as one expense. So I'm going to agree with the solution as far as formatting is concerned. Being multi-step, the only thing that I can say is that instead of having a selling and general expenses, you would have a complete, you'd have a listing of the expenses. And in this case here, the total would end up being $46,300 as my total expense. The formatting being two different columns is all right, but instead of having just two expense accounts there, I might have 10 or 15. So that's the only deviation from the solution, and I'll kind of point that out when I'm creating it. Right? So I'm not going to spend a lot of time going over the theory behind the creation of this. Again, if the theory is, go back to chapter 2 and chapter 3, where we did create a lot of income statements, and then of course now we're in chapter 4 and go back through some of the exercises. because the income statements are starting to get more and more complicated. Okay, you know, just as a quick, remember, on an income statement, we simply, if we had one general ledger account called revenue and one account called expense, that would give us a profit or loss. And the only information that we get out of that is we know our profit or loss. Having numbers for revenues and expenses doesn't mean anything to us. So the reason why we create multiple different ledger accounts is so that we can analyze the information better. Okay, and in that analysis, we're creating more and more accounts, and we're looking at things in a different way, but we kind of create the income statement and the balance sheet following the same generally accepted accounting principles. Okay, so even though no matter what businesses you're looking at, they follow sort of like the same format, even though they may look very, very different, right? And of course, I'm going to just take liberties since I'm doing my, this is not a classified financial statement. So I'm not going to spend a lot of time writing everything out and wasting time. Okay, so I will take shortcuts like, fresh foods here. I'm going to abbreviate. I'm not worrying about capitalization. I'm more worried about things from a formatting perspective of, center aligned, left aligned, right aligned, indenting, underlines, double underlines, dollar signs. Those are the kinds of, and the correct dates. Those are the things that are very important on the financial statement. But my abbreviating and not worrying about capitalization and things like that are secondary. That's just to be able to get through this. If I were to present this, if this was a test question, I type it up very, very different and would look similar to what's in the solution manual. But here, it's just for learning, so it is what it is. So income statement, and this here is for the month of November 30, for the month ended November 30th. So they put, the solution shows month ended November 30th, 2014. You could have written it as for the period ending. And then November, right? Or for the month ending. Right? For the month ending, all right? So any of these ways is just fine, but just remember that the income statement is for a period of time. So you have to designate that period by saying it's a month, it's 4 weeks, it's 6 months, it's 1 year, whatever that period of time is. Okay, so I put the heading in, and of course that's center aligned. Then what I do is I write my revenues, and I write my expenses as my category of accounts. And now I'm going to start filling in, okay? They didn't show the revenue, I do, and that's just a preference because it's the way I always create. I know that this here is my revenue section, and even though anybody who understands accounting knows revenues come first, it's always just helpful to have it there. So then I'll indent a little bit, and the first, I'm going to put my revenue accounts, okay, and then I'll indent again, and less sales discounts, less sales return and allowance. Now they have the return and allowance first, then they have the discount second. Does it matter? No, it doesn't. It's just a matter of whatever, when you're looking at your chart of accounts, whichever one came first, that's the one you're going to put first, okay? And for whatever reason they changed it up, but usually discounts come before return and allowance, because you have your chances are you're going to give more discounts than you're going to give returns and allowances. Okay, so then that's going to give us a net sales revenue. And I'm going to erase the expense here because I need some space. Okay, and so I'm going to start putting in some numbers here. So I don't agree with the 214,700 being in the right-hand column. because I'm doing a mathematical calculation for these three. And when I do that math calculation, right, I have 3,800 and 4,300. Oops, I got those backwards because I do 4,300 and 3,800. Which gives me 206,600. Okay, so I do the math, and remember the total goes, to over into the next column, right? So then, since I have my net sales revenue, I take out my cost of goods sold, which is 102,600, and that would give me a gross profit. So I need three columns here, and there's nothing wrong with the way I'm doing this by figuring out the columns, right? As you can see, 4,300, 3,800, which gives me 206,600, and then 102,600, and that's going to give me a gross profit. Oops, I want to indent my cost of goods sold. That's going to give me a gross profit of 104,000. Now remember, in this right-hand column, normally it would be revenues less expenses, but we're expanding our revenue section here to by taking into consideration our cost of goods sold. So what we're left with is our gross profit, and from our gross profit we're going to take out our total expenses to get our profit or loss down here. So that's why I'm bumping over all of the columns, right? So it's easy to just look and say, okay, I have 104,000 in gross profit less whatever my expenses were. If I want to know what my sales are, I can see my sales are 206,000. Or how do I get to my gross profit? There's the calculation right there. Okay. All right. So now with expenses, they're calling it operating expenses, and that's just fine. And they're again selling. Now here's where I would actually list all of my expenses, okay, not just a grouping of the two of them, right? And I'm going to, so this is going to be they're calling it operating income. I'm going to call this total expenses. Total operating expenses. Total operating expenses. So I know that's because I'm going to be dealing with other expenses, I'm going to want the total operating expenses here. So I'm going to have this column and have my 25,400 here and 20,900 here in this column to give me my 46,300 here. And how we deal with having a separate section for other expenses, I explained this in the other video, in the other exercises. I mean, a lot of businesses, if all they have is just interest expense and it's associated with the operating expenses, like let's say, for example, a late payment, okay, you might get charged penalties and interest. Well, they'll make the interest expense and as one of the operating expenses. But if the interest expense is if the interest expense is due to interest on a financial instrument, okay, then they'll separate the interest expense out and call it other expenses. So, and since I only have one, okay, I'm just going to keep it on one line. I mean, I could have put interest expense here, but I'm not really doing any math here, so I can just keep it on one line and put the interest expense here of 1,350. Okay, and then I have my total expenses here, which then becomes, oh, let's see here. I have to do the math. That's 47,650. Okay, so that's 47,650. And then here would end up being my net income, which $sign ends up being 56,350, and double underline because it's the end of the mathematical calculation. Right, so I hope you got that. Basically, remember, we have everything is just an expansion here. I'm expanding my revenue section. I'm expanding my expense section in that I'm going to break it out as they're calling it operating expense. You might even see it as selling and an administration expense. But generally, you'll have two sections there. One is the selling and admin expense, or the operating expenses, and then you'll have the additional interest expense if the interest happens to be coming from, the financial instruments, like for example, I have a mortgage. I have a principal amount and an interest amount that's part of that that mortgage payment. So when I pay it, all right, I can't, just, if I have to give some idea, if I borrow, say, $100,000 for a mortgage, and let's say my monthly payments each month is $1,000. Well, that $1,000 isn't just principal, okay? It's principal plus interest. So when I go to pay that $1,000, and let's just call it 600, no, let's call it 400 in principal. Call it 400 in principal and 600 in interest. Okay, I can't put the full 1,000 like when I go to pay in cash. So I'm going to credit my cash for 1,000, and I'm going to debit what, mortgage payable, okay, for 1,000. No, that's not right, because I'm not paying off a full 1,000. Okay, I'm only paying off 400 in principal. So I also have to debit interest expense for 600, and the mortgage payable is only 400. So now, instead of owing 100,000, I owe $99,600. Okay, so that's more correct. Okay, so I hope you see that and understand why we're making that separate entry for the interest there, because it's a part of that particular payment. All right, and because of that, now I have this interest expense, and where am I going to show this interest expense? It's not part of the operating expense, right? It's part of the interest on a financial instrument, and that's why they separate out the other expenses. Okay, and then the bottom line is, if I'm looking down this column here, I have my gross profit less my expenses to give me my net income right here. So everything flows and is easy to understand. Okay. All right. So now the question, the problem says calculate the gross profit percentage. So I'm going to kind of like do this on the same slide here. Gross profit percentage, remember, is over net sales revenue, and the numerator is the gross profit. Okay. And I remember that formula only because because if you watch the theory videos, I know net sales goes in the bottom, and because it says gross profit, I know that's what goes in the numerator. So my gross profit here is 104,000, and it goes over what my net sales are. Well, what's my net sales? My net sales are 206 600, and if I do that division, I end up with 50.3%. Okay, so then so that's part B there, calculate the gross profit. Now it says, what does Fresh Foods gross profit percentage mean? Okay. If you look at the solution, it says the percentage means that each dollar of net sales generates 50.3 cents of gross profit that is used to cover operating expenses, interest expenses, and generate net income, right? And that is true, okay? And the only thing that I want to add to that is that that percentage, whatever it is, does not, you can only compare it against itself. So in other words, from accounting period to accounting period, you want to pay attention to whether that gross profit percentage is going up or down. But it in no way reflects anything that has to do with your bottom line. All it basically is that this is in a percentage form how much money is available in order to pay all of your expenses, your selling and admin expenses, right? In the hospitality industry, it's not unusual for them to work on gross profit percentages 25 or 26%, okay? And they're still able to pay off all of their expenses because of the amount of volume that they do, okay? You think in terms of the expenses almost being as fixed, even though they're not exactly the same. It's not like rent expenses $1,000 each and every month. That's a true fixed cost, a fixed expense. But for the most part, your expenses are going to stay within a certain amount, a certain realm, within a certain amount. They shouldn't deviate that much. And so if you have a high enough gross profit percentage, that's the money that you have available in order to be able to pay off your expenses. So in the case of here with this Fresh Foods, it being at 50%, they're making twice as much as in gross profit as any restaurant, and that may be the case for the food wholesalers, okay. But when that comes to when they sell to a restaurant, well, if in the case of, let's just say, lobster, if they're selling lobster to the restaurant at $10 an ounce, okay, and the restaurant can only, sure, they're going to sell it as a meal at Red Lobster for $20, right? Don't forget, we're talking about so Red Lobster sells for $20. It costs them $10 for the lobster. So you think, oh, they have $10 in gross profit. No, but they have things like, the mashed potatoes, the muffins, things like this. And so that's why they might, it might cost Red Lobster $15 to put on the plate, and they're selling it to you for $20 to make the gross profit of $5. And from that, they have to pay the rest of the expenses. So you really can't judge a business based upon the gross profit percentage. What you do judge it on is, and I picked lobster as an example, because what you do judge it on is if for the month of November, right, your gross profit percentage is 50, and then in December your gross profit percentage is 40, and then in January your gross profit percentage is 30. Obviously there's a decline there, okay? And then if you go into February and it goes up to, say, 35, now it's going up a little bit. That's where paying attention to the gross profit percentage makes sense, because businesses are seasonal. Take, for example, an ice cream shop. If all they do is sell ice cream, well, not too many people are going to buy ice cream in January and February, right? But in June and July, a lot of people are buying ice cream. So the numbers do vary, greatly, in a seasonal aspect, and it's important to pay attention to that, to those changes. Remember, you're creating the information in order to be able to do analysis. Okay. So with that said, I'm done with this problem, and if you don't understand something, go ahead and watch the video again. But then, if you don't understand the theory, watch previous theory videos. I try to point out where. And then if you still don't get it, feel free to contact an instructor.